Good day, economics students. Welcome to another online lecture. The purpose of this lecture is to introduce students to what economists refer to as the theory of the firm. So we're going to go over the idea of owning and operating a business, and more specifically, we're going to investigate thoroughly the principles related to costs of production. So let's talk about cost, economic cost of production. To run any business, what do you need to acquire? Obviously, resources, land, capital, labor, and entrepreneurial resources. So you can think of cost, economic cost, as simply the payment for acquiring and using economic resources. So it's interesting the way accountants see the world and judge costs versus the way economists see and view the world and judge costs. So accountants identify what we refer to as explicit costs. Explicit costs are monetary payments that you make to acquire and use land, capital, and labor. So for instance, assume you own a bakery, right? You have to pay for all of the supplies to make the baked goods. You have to pay for the labor, you have to pay for the ovens, you have to pay for rent, you have to pay maybe insurance on the business or maybe insurance on the building, right? All of those would be referred to as explicit costs. They're right there, obvious. You write a check for them or you send the money electronically to cover the costs. As opposed to implicit costs, the best term to help you remember the idea of implicit cost is this is the opportunity cost related to the business owner. In other words, did the business owner put some of their own land into this venture? Did they put some of their own capital into the venture? Did they put some of their own money into the venture? And are they being compensated, or what is their time, talent, and energies worth? So this is an important idea, the idea that economists don't consider just the explicit cost. They say, well, if you want to see how well a business is doing, whether or not they're making a profit, and of course, the whole purpose of running a business is to make a profit, you have to consider not only explicit costs, but also implicit cost. Now, we will talk about in a few moments this idea of normal profit and what that principle or idea means to an economist. Okay, so quick review. Explicit costs versus implicit costs. All right, the meaning, right? Explicit costs are the ones that right there the company pays for the uses of inputs, factors of production, or resources, as opposed to your implicit costs, right? Explicit costs are easy to see. Implicit costs, well, the company uses for the owner's time, talents, and resources. All right. Alternatively known as, we don't use this very much, but out-of-pocket costs for the explicit costs, or imputed, or we do use opportunity costs for the idea of the implicit costs. All right, determining costs. Well, explicit costs, it's so easy to determine what explicit costs are, right? Your rent bill comes, you got to pay what the rent is, right? You want to acquire supplies, they cost this much. All right, what are you paying your labor per hour? It costs that much. So it's easy to determine your explicit costs. Sometimes it's not so easy to precisely tackle the challenge of calculating the implicit cost. So for instance, all right, the owner of the business, what else could they be doing with their time, talent, and energy? All right, you can make an estimation of what salary they could be earning somewhere else, and what are their entrepreneurial talents worth. Again, you have some idea, but it's sort of a subjective number to come up with, right? Now, interestingly enough, we talk about what cash, explicit cost requires a cash outlay. You have to pay money if you want your workers to keep coming to work, right? You have to pay money if you want your suppliers to drop off the supply. If you don't pay your rent, the owner of the building is going to say, hey, you gotta get out, right? Now, as opposed to the implicit cost, it's funny. It's like, okay, you're not really. Let's say you're trying to calculate the value of the owner's time, talent, and energy. Well, in the mind of the owner, the man or the woman who is running the business, who owns the business, the entrepreneur, you can have an idea of what that is worth, but they don't need to necessarily write a check for that, right? So it's interesting it's not a cash outlay. Okay, so here's the big idea when we talk about calculating profit. So the difference between the way economists and accountants view profit. Is the company ultimately making money? All right. Well, first we talk about revenue. Something we covered when we talked about the chapter of elasticity. Price of what you're selling times quantity equals your revenue. Okay. So that's an easy enough concept. To an accountant, you say, okay, is the business making money? Well, whether you're a corporation or you're just a little tiny cookie shop in the city of Philadelphia, you ultimately have to pay taxes on your business. So accounting profits are important from that standpoint because it's the way the government's going to view whether or not you're making money, and if you're profitable, what you owe in taxes, right? So it's simple. You take your revenue that you generate from your operating your business minus your explicit costs. And there you have your accounting profit. But the economist says, hold on for a second. The accounting profit's not really the whole story here. The accountant says, all right, let's look at, the economist says, look at what we have to pay as far as acquiring and retaining the skills and the entrepreneur ability of the owner of the business. So if we take the accounting profit and say, okay, well, what about the opportunity cost of acquiring the business owner to keep putting their effort and energy into this endeavor, right? So if you think about calculating economic profit, you take total revenue minus all cost, land, capital, labor, and the opportunity cost of how the owner's talents and time could have been used elsewhere. So economic profit is simply total revenue minus all costs, which includes explicit and implicit costs. We will use a number example to drive this important idea home. This slide helps us visualize the ideas we introduced on the previous slide. The difference between accounting profit and economic profit. So on the right-hand side, you see how accounting profit is calculated, right? You say, okay, you take total revenue and you subtract all of the explicit costs, and whatever is left over is going to be your accounting profit. The economist says, wait, hold a second. You really need to consider the implicit costs, the opportunity cost of how the owner's resources could have been used, owner's talents could have been used elsewhere. So you still take the idea of revenue, but then you say, okay, we have to subtract out both the explicit costs and the implicit costs, and that will give you the economic profit for the firm. This numerical example will help us understand exactly what we are talking about. All right, so top line, total revenue. So this, it could be a landscaping business, right? The landscaping business generated $300,000 worth of revenue this year, right? That was the revenue for the year. All right, if you add their labor, their materials, their utility, and their rent, and for simplicity, we'll assume those are their only cost. Now, of course, in the real world, there'll be more, but just for the sake of this example, this business has $165,000 worth of explicit costs. So cash outlays for labor, materials, utilities, rent. Right, they had to write checks for these explicit costs. So according to the accountant, you take the $300,000 worth of revenue minus the $165,000 worth of explicit costs, and this firm made an accounting profit of $135,000. But the economist doesn't agree with this outcome. The economist says, wait, hold on. What about the land that is being used to store all of the tractors and such, right? What about the owner of the business? Did they donate that land to the endeavor? In other words, did they take land that they owned and use it for the business, right? So let's assume that land is worth $65,000. Well, that's an implicit cost. And then say, what if the owner of the business wasn't working at the landscaping business, but maybe they could be making $60,000 somewhere else. So if we consider the opportunity cost of the owner's portion of the resources, right? We say, man, the implicit cost, they add up to $125,000. From that standpoint, the business isn't generating a profit of $135,000, but only $10,000 of economic profit. Now, this is an important idea. Sometimes when economic students are introduced to what's called normal profits, they really fail to understand what that principle means, right? So think of it like this. Imagine if you owned a business. You obviously have to pay for the land, capital, and labor that you're using to run the business, right? So that's your explicit costs. And then you would evaluate your own personal involvement with the business and ask yourself, am I being compensated for my time, talent, efforts, energy, and resources? Implicit costs. Well, in this case, for this example of the landscaper, all of the costs are being covered and there are still $10,000 worth of economic profit. So the owner of the business is happy because, geez, they've already considered what their time, talent, and efforts are worth and their contribution of resources to the project are worth. That's $125,000 a year. And there's still $10,000 additional left over, right? Now, economists believe that because of competition, when there's economic profit to be had, it would most likely encourage new participants into the market. In other words, other entrepreneurs realize that, man, there's a lot of landscaping trucks out there. Landscapers must be making money. Maybe I'll open a landscaping business, right? So a key idea here is that over long periods of time where there's very few barriers to entry for new participants in the market, if a new business wants to enter this industry, we would actually expect economic profits to be zero, and we refer to that as normal profit. In other words, the total revenue, right, minus the explicit costs and minus the implicit costs will turn out to be zero. And what we're saying there is the revenue generated from the firm, from the operations of business, is enough to cover not only the cash outlays of the explicit costs, but also what the owner thinks their contribution of resources is worth to keep the firm running. So in the long run, we believe economic profits will be zero, and we call that idea normal profit. So let's now turn our attention to differentiating for the firm the difference between the short run and the long run. And most of our analysis for our theory of the firm cost of production chapter will be on the short run. So short run versus long run. The first important idea is there's not a set or fixed time to determine short run versus long run. It's going to completely depend on the nature of the business, the nature of the industry. So this is not an accounting class. In accounting, you may have learned 1 year or less is the short run. Anything over than a year is the long run. That's not the way economists see the world. For an economist, the short run has an extremely important characteristic. It's the period of time when at least some of your resources are fixed. In other words, think about the size of your plant, your factory, or the size of the manufacturing facility that the business uses for everyday operations, right? So if we're a manufacturing facility and we have, say, a 1,200 square foot building, and inside there we have 70 machines, right? Well, for the time being, we're at capacity utilization. If we wanted to expand, we would have to go buy some more land. We would have to construct a new building. We'd have to buy more equipment. That might take 5 years in our industry. So for our industry, if we're a small manufacturing, the short run is 5 years. It's the period of time when the size of our plant or our factory or our capital is fixed. Now, in the short run then, you have variable inputs where they can be adjusted, right? In other words, things like labor, utilities, and raw materials, right? We can adjust the amount of those variable inputs that we use on a daily or weekly basis, but for the time being, the size of the plant is fixed. The long run obviously is opposite. In the long run, all inputs are variable, all resources, even the size of the plant, right? Think of it at a time when, okay, we had enough length of time to submit our plans, acquire the land, build a new factory. So all resources, even the size of the plant or the factory or the manufacturing firm itself is variable, right? It also allows firms to enter and exit the industry. In other words, new participants to join this industry as competitors. So let's think about the difference between the short run and the long run for two different types of industry. If we looked at a service type industry, something like, hey, a small accounting firm, right? So we open an accounting firm, we rent a 1-year lease for a small office in a strip mall somewhere. We hire 5 accountants, and we're doing well. There's a significant demand for our services. You know, let's say we offer both personal tax returns and some corporate tax advice. And all of a sudden, man, we have so much business. We need to hire more people. We need more space, right? Man, we could probably get out of our lease within 60 days and rent a larger facility, right? Now, we might be stuck in that lease till the end of the year, depending on the situation with what our lease says about breaking the lease early. It might even be in our best interest to pay the fee to break the lease early. So in that situation, for a service type business, the short run versus the long run, the short run might be 2 months, less than a year, because we don't really have a lot of equipment. We have some laptops. It's mostly intellectual exercises associated with software, as opposed to Boeing or Airbus, right? These are extremely large manufacturing firms. If you've ever seen a documentary about the Boeing or Airbus facility, they're 8 or 9 football fields large, right? It could be 10 years before you're able to expand your ability to produce more airplanes, because, building a manufacturing firm of that size, it's going to take the better part of a decade. So just remember that the short run versus the long run, it's not a fixed period of time. It's going to depend on the nature of the industry. So we are evaluating the short run production relationships between our fixed resource, the size of the factory, our capital, and our variable resource, labor. Remember, the short run is the period of time when the size of our firm is fixed. We cannot make it any bigger. We can't make the walls any wider, and we can't increase the number of machines we have in our factory, right? So we're really looking at the relationship between adding labor, a variable input, to our fixed resource capital. A couple of definitions here to begin our short run production relationship analysis. Total product. This one's pretty straightforward. Simply, how many units are we producing? Now, this could be per day, per week, per month. For simplicity, let's assume it's per day, okay? So, if we add a worker to our factory, how many units? What's the output of the factory per day? So if we were making something like, I don't know, picnic tables or lamps or sneakers or any physical product, right? Say, okay, we add 1 worker, what's total production for the firm? All right. If we add a second worker, what's total production for the firm? All right. So total product. Economic thinking is marginal thinking. Marginal product is the next idea. Any type of marginal analysis is always going to include change, right? So what is marginal analysis? Most decisions involve changes in the status quo. So look what we're measuring here. Change in total output over change in labor input. So in other words, what is the change in output associated with hiring the next worker, right? What's the next worker's contribution to total output? How much does total output change given an additional worker. So change in total product over change in labor. Now, we're only going to be measuring change in total product over one additional labor, so our denominator will always be 1. Now, average product is a measure of efficiency. You just take total product divided by units of labor, number of people working, and we'll see that as a measure of economic efficiency for the firm. Now, what we're going to do is we're going to take these ideas, we'll look at them numerically, and we'll look at them graphically. The law of diminishing returns, an important economic principle for you to understand. In the short run, we can't expect to continue to add variable inputs to our factory, the firm, our plant, and expect output to continue to increase. The very nature of the short run gives rise to this law of diminishing returns. For the time being, we only have so much space available in our factory, so many machines available to work. So what happens is, as we add a variable input, labor, right, to our fixed resource capital, right, initially output increases at an increasing rate, and then output increases at a decreasing rate, and that's when diminishing returns begins to set in. And at some point, if we continue to add labor to our factory, output would actually start to decline. Now, the economic rationale behind this is quite simple, right? If we could simply add workers to our factory and expect output to continue to increase, right? You could have the smallest factory in the world and you could produce, the entire world's supply of sneakers, right? So think about a fictitious pizza shop, right? So assume we own a pizza shop on the Ocean City Boardwalk, like Mac and Mango, super popular spot where people go to enjoy their summertime pizza by the beach, right? So imagine if we were owning and operating Mac and Mango's Pizza. I know now it's changed names to Mac and Mac, but Mac and Mango's is crazy super busy all summer, but most busy around 4th of July weekend, right? So imagine it's 4th of July weekend, we're Mac and Mango's, we're open from 10 a.m. to 10 p.m. There's a line from the counter all the way down the boardwalk, people waiting for our pizza. How many workers would we hire? Well, turns out we wouldn't hire 30 workers. We'd only hire 8 people. Why? Well, because we can't expect to just keep adding workers to our factory, to our pizza shop, and be able to increase the production rate. Because why? Beyond some point, the factory starts to get crowded, right? It's cumbersome within the confines of our pizza factory. So even though we have anxious customers patiently waiting for their pizza, we don't add additional workers because we know the economics of the law of diminishing returns, right? As we add a variable input, labor, to our fixed resource capital, initially output increases at an increasing rate, but beyond some point, the next worker will contribute less to total product than the previous worker, so output starts to increase at a decreasing rate, diminishing returns, and then eventually, if you kept adding workers, output would actually start to go down, right? So this table down bottom will help us reinforce these important ideas. So column 1 and column 2 are straightforward, easy to understand. Column 1 is simply a measure of the number of workers we have at our firm, our factory, our plant. So our units of variable input, labor, right? So 0 through 8 potential workers. Column 2 calculates, all right, what would production amount to if we hire that number of workers? So we take column number 1 and say, okay, if we have 2 people working at the firm, we would expect production per day to be 25 units. If we have 5 people working at the firm, we would expect production to be 10, 25, 45, 60, 70 units per day. Okay, that's where the 5th worker lines up with total product. So economic thinking is marginal thinking. Column 3, marginal product. What's the change in total product associated with hiring the next worker? This column is important for 2 reasons. Number 1, obviously you need to be able to calculate marginal product. More importantly, it highlights and demonstrates in detail, and we will see on the next page in graphic detail, because we can use a graph to explain this and to express it, the law of diminishing returns. Let's look at the marginal product or the change in total product associated with hiring the first 3 workers. Well, obviously, if we have 0 people working, our total product is 0, so we have to add somebody to the factory. Now remember that somebody has to do everything, right? So if we add 1 person, 1 worker, 1 unit of labor to our fixed resource, our capital, our factory, what total product increases from 0 to 10, so the marginal product of the first worker is 10. Right? Well, let's add another person. That way they can share some of the responsibilities. So adding a second worker, look what happens. Total product increases from 10 to 25. Therefore, the marginal product of the second worker is 15. Notice that the marginal product of the second worker is greater than the first worker. And this continues for 1 more worker. If we add another worker, another unit of labor resource, all right, output increases from 25 up to 45. Therefore, the marginal product associated with that third worker is 20, right? Marginal product is measuring change in total product associated with the next worker. The third worker, total product increased from 25 to 45. Therefore, the marginal product associated with the third worker is 20. Now, look what happens beyond the third worker. Already for this firm, diminishing returns has set in. Right? Now, an important idea here. Just because diminishing returns has set in for this firm or factory, for this plant, does not mean you wouldn't hire the 4th worker. Total product is still increasing. Look, if we hire a 4th worker, the firm can now produce 60 units per day as opposed to 45. So with only 3 people working, total product is 45. With 4 people working, total product is 60. The marginal product of the 4th worker is positive. It's 15. Output increased from 45 to 60. But look, the marginal product of the 4th worker is less than the 3rd worker. So for this particular firm, diminishing returns sets in with the addition of the 4th unit of labor, hiring that 4th worker. Notice that diminishing returns continues through the 4th, 5th, and 6th worker, right? The marginal product of the 5th worker is 10, which is less than the 4th, and the marginal product of the 6th worker is 5, which is less than the 5th worker, right? So over that range of 4, 5, and 6 workers, diminishing returns. Now look what would happen if we got ridiculous and said, oh man, what happens if we hire a 7th or 8th worker? Well, this is the land of what we call negative marginal returns. If you hire the 7th worker, production doesn't go down, but remember, you'd still have to pay that person. We're not talking about cost yet. But there's no increase in total product with the 7th worker. They don't have anything to do. They're standing around, right? Now the 8th worker, man, they're getting in the way. Look, total product actually declines from 75 to 70. So you would never hire the 7th worker. They're not doing anything. And you'd be completely insane and economically challenged to hire the 8th worker because, heck, your total production for the firm would actually decline from 75 to 70. The marginal product associated with the 8th worker is -5. So this firm may hire up to and including 6 workers because total product is still increasing. Last column, average product, a measure of efficiency. How do we calculate the last column? This is a simple math problem here. You simply take column number 2, total product, divided by column number 1, number of workers, and that gives you your average product. Let's look at and explain these 3 ideas of total product, marginal product, and average product graphically, and we can also reinvestigate the importance of and demonstrate with a nice picture the law of diminishing returns. So on the top we have graphed the total product curve. Down bottom we have the marginal product and the average product curve. In both of these graphs we have production on the vertical axis, number of units produced on the vertical axis, and on the horizontal axis we have the number of workers, the quantity of workers. Over the first 3 workers, what's happening, right? Let's look up top here. I'll say this a few times because it's kind of not all that intuitive when you first hear it. Over the range of worker 1, 2, and 3, what's happening is total product is increasing at an increasing rate. I'll say that again. Total product is increasing at an increasing rate. That is to say, the marginal product of each successive worker, 1, 2, 3, adds more to total product than the previous worker. Also notice over that range that not only is the total product curve rising at an increasing rate, marginal product continues to increase at an increasing rate. But beyond the third worker, what happens? Diminishing marginal returns, right? So the marginal product associated with the fourth worker is less than the third worker. Notice that at worker number 3, marginal product has reached its peak. Also notice that the marginal product curve intersects with the average product curve at its maximum. So the fourth worker contributes less to total production than the third worker. Again, it doesn't mean that the fourth worker would not be hired. It simply means that diminishing returns have already set in because that economic reality of short run, size of our factory is fixed, we can't keep adding a variable input to our fixed resource cost. All right. Notice that the fifth worker, the marginal product of the fifth worker is still positive, 10, and the marginal product of the sixth worker is still positive. But beyond the sixth worker, right, seventh worker, the marginal product is 0, and the marginal product associated with the eighth worker, what happens? Oh, we actually have negative marginal returns associated with the eighth worker. One last thought. It's important to understand the law of diminishing returns as an economic phenomena that is inescapable because of the reality of the short-run production relationships between the size of the factory and our variable input labor. It has nothing to do with the efforts or talents of the worker. So in other words, diminishing returns does not begin because the fourth worker is any less competent than the third worker. It's just because of the economic reality of adding a variable input labor to our fixed resource cost. As you begin to add that variable resource, output increases at an increasing rate, the yellow portion of the total product curve. Then output continues to increase, but at a diminishing rate, the greenish portion, the middle portion of the total product curve. And at some point, output would actually decline if you continue to add workers to your factory. Okay, now we're going to evaluate short-run production, but not from the standpoint of output, but from the standpoint of costs. So this is short-run production cost. We're still evaluating the relationship between our fixed resource capital and our variable input labor, but now we're going to evaluate those relationships in the short run, the period of time when our size of our plant or factory is fixed and our variable inputs are adjustable, right? Short run production cost. So a couple definitions: fixed cost versus variable cost. A fixed cost, costs that are unavoidable and do not vary with the firm's level of output. I'll say that one more time. Costs that are unavoidable and do not vary with the firm's level of output. Now, what do we mean by unavoidable? In other words, we have to pay these costs regardless if we keep the factory open 0 hours per week or 20 hours a day per week, right? It doesn't matter if we crank out 1 million units per month or we crank out 0 units per month. These costs are going to be the same. So they're unavoidable. They do not vary with the firm or the business's level of output. So what would be a good example of this? All right, think about this. If we have to pay an insurance premium to be in business, the insurance company will come evaluate our facility and they'll do some type of safety inspection, and they'll say, all right, for you guys to operate, it's a total of $2,500 per year, right? So regardless of how many units we produce, we have to pay that cost, right? Now think about it. If we're renting a building, the landlord doesn't care if we're crazy busy 24/7 or we barely use the space. We have to pay the rent regardless of how little or how much the firm produces. So we can literally produce nothing this month, and we still have to pay the monthly rent, right? So fixed costs, they have nothing to do with, they're completely unrelated to the firm's level of output, and they're unavoidable. We have to pay them. Obviously, variable costs, directly really related to the firm's level of output, right? So if you think about a manufacturing firm, they have to hire labor and they need materials to produce, right? If we are a bakery, then we need workers and we need flour and we need sugar, right? And the more we produce, the more of those variable inputs we need. So a business's variable costs will be directly related to the firm's level of output, and it will vary based on whether output increases or decreases. Total cost is simple enough, right? You add together your fixed cost and your variable cost, and you get your total cost, right? So total fixed cost plus total variable cost equals total cost. Let's look at this idea graphically. Our red total fixed cost curve. Now, if we look on a vertical axis, it's measuring costs in thousands of dollars, right? On the horizontal axis, we're measuring how many units this firm is producing, right? Our level of output. So again, dollar cost on the vertical axis to the firm, horizontal axis, number of units being produced. So for this firm, what's going on? Okay, if we don't produce any units of output, or we produce 100,000 units per day, the fixed cost is the same, 100, right? So again, that's our rent, that's our insurance premiums, right? It would also be something like a salary for a manager. All right, so the manager is going to get paid regardless of how many units we produce this month, right? Fixed cost, unavoidable, have to pay them, and do not vary one iota with the firm's level of outputs. Total variable costs, right? Total variable costs, obviously, going to be completely related to how many variable inputs we use and our level of output. As we produce more, our variable costs are going to increase. Now, to get our total cost, our purplish blue curve, notice what we're going to do is say, okay, well, we have to pay our fixed cost, our red curve. So we start our cost structure there at 100, and we simply add to it our total variable cost. So we shift the total variable cost up the vertical axis from 0 to where our fixed costs begin, and we can construct our total cost curve, right? Our bluish purplish total cost curve. So if these units are in hundreds of dollars or thousands of dollars, right? Even if this firm produces nothing, right? They're going to pay cost of 100. So unavoidable, do not change with the firm's level of output. Now, per unit or average costs. We spend far more time analyzing and examining per unit or average costs. Really want to pay attention here, really want to get these down, because when you go to study market models, pure competition, monopoly, oligopoly, monopolistic competition, we're going to employ our knowledge and understanding of the cost structure of the firm to determine what level of output a firm should produce to generate the most profit or try to avoid loss in the short run. And therefore, you need a thorough understanding of the cost structure and the average cost per unit cost curves that we are going to construct here, because we definitely use these going forward. Right? So we got 4 of them: average fixed cost, average variable cost, marginal costs, and average total costs. Right? Average fixed cost, average variable cost, marginal cost, and average total cost. So notice how these are calculated, right? Anything average is going to involve what? Division, right? So, okay, something divided by something. So average fixed cost is simply your total fixed cost divided by your quantity of output, right? We will see on the next slide that average fixed costs drop substantially with each level of output. This is known as spreading out the overhead. Average variable cost, take your variable cost, divide it by your quantity. That gives you your average variable cost. So take your total variable cost divided by quantity of output, average variable cost. Right? Marginal cost, the change in total cost associated with producing the next unit of output. The change in total cost associated with the next unit of output. And average total cost. So we can take either, we can calculate this either by adding average fixed cost plus average variable cost to get average total cost, or simply take total cost divided by quantity, and we will come up with the same number. Now that we have a definition and working understanding of our four cost curves, average total cost, average fixed cost, average variable cost, and marginal cost, let's look at these cost curves graphically. On the horizontal axis, we're measuring costs. On the vertical axis, quantity of output. So let's first discuss the green average fixed cost curve. So, how do we calculate average fixed cost? We take total fixed cost, costs which are unavoidable and do not vary at the firm's level of output, and we divide it by quantity of output. So, if we're producing 1 unit of output and our firm's fixed costs are 100, 100 divided by 1 is 100. That's where we get that number, right? Notice that average fixed costs drop quite quickly. Second unit of output, right, you're dividing 100 by 2, average fixed cost drops to 50, then down to 33, then down to 25, right? So that's why the average fixed cost curve is so steep in that initial range of the average fixed cost curve. Now, average variable cost. What's average variable cost? Well, total variable cost divided by quantity of output, right? So if you look at this, what shape does it resemble? It's a U, okay? So initially, average variable costs are a little bit high, then they begin to fall, and then beyond some point, they begin to rise, right? So the average variable cost curve reflects the law of diminishing returns from the standpoint of cost as opposed to production when we looked at marginal product curve. Our average total cost curve. So if we were to add together our average fixed cost and our average variable cost curve, that would give us our average total cost curve. The average total cost curve is extremely important because it's going to help us determine whether or not we are making a short-run profit or suffering a short-run loss. Finally, and definitely not last but not least, marginal cost. All right, before we start getting into numbers, the principle or the concept is really important. Marginal cost, the change in total cost associated with producing the next unit of output. The change in total cost associated with producing the next unit of output. Notice the relationship between the marginal cost curve, the average variable cost curve, and the average total cost curve. The marginal cost curve intersects the average variable cost curve and the average total cost curve at their minimum point. Now this should make sense mathematically to you and intuitively. Why? What's happening? As long as marginal costs are dropping, now what's marginal cost measuring? It's measuring the change in total cost associated with producing the next unit of output, right? The change in total cost associated with producing the next unit of output. So, as long as the marginal cost of the next unit of output is actually lowering costs, it's pulling down the average, and the average fixed cost, the average variable cost and the average total cost, right? As long as the marginal costs are falling, that's pulling down the average variable cost and the average total cost. When marginal costs begin to rise, so do average variable cost and average total cost. Think of it in these terms, right? Assume you had taken 2 tests already and you got an 80 on each test, or your grade for the first 2 tests averages out to 80, all right? Your marginal score is your score on the next exam. If your score on the next exam is lower, it will pull down the average. If your